Welcome to the deep dive. Our mission, as always, is pretty straightforward. We dig through the analysis, the financials, the strategy docs, and we pull out the insights you need nice and efficiently.
And today, we are going deep on a true corporate behemoth, Procter & Gamble Company, P&G.
Right. Nearly 190 years old, a titan in global consumer staples. We're talking about those brands you probably use every single day without even thinking twice. Tide, Pampers, Crest, you name it.
Exactly. And when you look at P&G, it's more than just a successful company, isn't it? It's this incredibly disciplined business machine.
That's what we want to get into. Our mission today is really to decode that strategic framework. We want to look hard at the investment case, but also, maybe more importantly right now, expose the structural threats, things that are genuinely testing its, century-old dominance here in late 2025.
Yeah, we need to understand the nuts and bolts. How does this cash machine actually work? Where does the growth really come from? And crucially, what's chipping away at that competitive moat P&G spent, 100 years building?
Okay, so let's dive right in with maybe the most basic question. How on earth does a company selling, let's be honest, fairly mundane stuffed dish soap, diapers, toothpaste, how do they generate a staggering $17.8 billion in operating cash flow in 1 year?
That's the number, yeah. $17.8 billion. It's huge. And the kind of performance, it really starts with how they're structured.
Right.
To understand where that cash comes from, you've got to break down P&G's business engine. It's highly focused now, remember. After years of strategic pruning, they really concentrate on this core portfolio. Daily use products where performance, how well it works and brand recognition, that's what drives your choice as a consumer.
And they organize this whole operation into 5 main segments.
5 key segments, yeah.
And let's call it the power dynamic between these 5 segments seems absolutely fundamental to P&G's whole financial picture. Looking at the fiscal year 2025 numbers, fabric and home care is just clearly the heavyweight.
Oh, absolutely. No question. This segment, you've got the massive global brands in there, Tide, Ariel, Dawn dish soap, Febreze. It pulled in a huge 36% of P&G's total net sales.
36%. Okay.
But here's the really critical bit. It also kicked in 35% of the net earnings. So it's not just big on the top line, it's incredibly profitable. This is P&G's cash flow engine, plain and simple.
Why is it so profitable, though?
Well, think about the products. They're essentially required goods, aren't they? You can't really put off buying laundry detergent or dish soap for very long, no matter what the economy's doing.
True. It's not like buying a new car.
Exactly. So that translates into this unparalleled stability, plus really strong brand loyalty built over decades. And that allows for consistent pricing power. People will pay for the Tide brand.
Okay, so fabric and home care is the powerhouse. Then moving down the list, you've got baby, feminine, and family care. That's about 24% of sales.
Yeah, 24%. And this gives them that next layer of really stable, non-discretionary revenue. Think Pampers, always Charmin. The revenue growth might not be spectacular there, but the stability is just golden for the overall business. Predictable.
Predictable cash. Got it. Next up is beauty, 18% of sales.
Right, beauty. And this segment is kind of interesting because it's almost two-tiered. You have the high-volume, mass-market stuff like Head & Shoulders, Pantene hair care, and then the specialized skincare like Olay.
Okay.
But what's really critical in beauty is their exposure to luxury. They have this super premium brand, SK2, which is huge in Asia especially. That gives P&G a really high-margin, sort of prestige presence. It's their way of playing in that luxury space, which helps balance out the lower margins on some of the mass market stuff.
Smart. Okay, then healthcare is 14% of sales. That's Crest, Oral-B, Vicks. Scientifically driven brands, they call them.
Yeah, science-backed positioning is key there. And finally, the smallest segment by revenue is grooming, clocking in at about 8% of total sales.
Only 8%, but I seem to recall reading it punches above its weight on profit.
It absolutely does.
Yeah.
Even though it's the smallest by sales, grooming actually contributes around 10% of the total net earnings. So, yeah, disproportionately profitable.
And why is that? Gillette.
Exactly. The high margin there is explicitly tied to that iconic, decades-old razor and blade model that Gillette perfected. You buy the handle, the durable part, maybe once every few years.
Yeah.
But then you need to keep buying those high-margin replacement cartridges.
Right, the refills.
Yeah, the refills. It generates this steady, high-profit annuity stream. That structure is what makes the segment so valuable, even though, it's facing some really intense competitive pressure lately from the direct-to-consumer shaving clubs and things like that.
Okay, that segment breakdown makes sense. Profit profile is clear. But let's pivot, like you said, to geography, because this seems like a major balancing act for P&G. Stability versus growth.
It really is. It's the classic twin engine challenge, as you put it. P&G is obviously global, but look where the money comes from. It's incredibly concentrated. A full 52% of all their sales come just from North America.
Wow, over half.
Over half.
Yeah.
And then you add Europe, that's another 22%. So you're talking over 70%, almost three-quarters of their entire revenue base is anchored in these highly developed, very mature markets.
Which, okay, provides that financial security that investors love, right? Predictability.
Definitely.
But it also dictates a pretty brutal growth strategy, doesn't it? If markets like the US are basically saturated, volume growth, selling more units is really tough. It's essentially capped.
Pretty much, yeah.
So P&G is forced to find growth in, what, two main ways. Either they have to steal market share from competitors like Unilever or Colgate, which is super expensive, a zero-sum game.
Right. Bloody battles for shelf space.
Or they have to rely on premiumization. That's the buzzword, right? The art of convincing you, the consumer, to trade up. Buy the more expensive, fancier version of their product, like Tide PODS instead of the basic liquid detergent.
Precisely. Convincing you that the new feature, the new scent, the new format is worth paying 10% more for.
Okay, so that's the developed market challenge. What about the other side? Emerging markets.
Well, in contrast, emerging markets think Asia-Pacific, Latin America, IMEA, which is India, Middle East, Africa. They offer vastly higher volume potential. Why? Because the per capita consumption of branded CPG products like fancy detergent or disposable diapers is still relatively low compared to the West.
So lots of room to grow the pie itself.
Huge room. However, these markets, while growing faster, still account for comparatively smaller chunks of P&G's total sales. And crucially, they require massive investment. Building factories, setting up local supply chains, figuring out localized marketing that resonates in Mumbai versus Shanghai. It's expensive.
So connecting this to the big picture then, P&G management has this constant tension. They have to pour resources, R&D dollars, into defending that slow-growing but super profitable core North America fabric and home care, where the margins are really fat.
Got to protect the cash cow.
Right, but at the same time, they have to invest heavily just to build the basic infrastructure on the frontier in those high-growth, less developed markets, which inevitably dilutes short-term returns, right? Costs money now for potential growth later.
It's a very, very expensive balancing act to sustain year after year. You're basically funding future growth out of current, hard-won profits from mature markets.
Okay, so how do they manage that complexity? You mentioned their stratagem model earlier.
Yeah, P&G formalized this years ago. They call it the integrated growth model. It's built on 5 pillars, 5 reinforcing pillars that are designed to give the business durability and withstand all this market pressure.
Okay, what are the 5 pillars?
So pillar 1 is the portfolio. That commitment we talked about, focusing only on those 10 core categories where product performance really drives consumer choice, getting rid of distractions.
A focus. Basic.
Pillar 2, and this is maybe the most expensive one, is superiority. They aim for superiority across everything. The product itself has to be better, the packaging needs to stand out, the execution in the retail store needs to be flawless, and the communication, the advertising has to be compelling.
Superiority across the board.
Ambitious. And that superiority costs money, which leads directly to pillar 3. Productivity. This isn't just about cutting costs randomly. It's a relentless, company-wide obsession with cost and cash efficiency.
How so?
P&G views productivity not just as a defensive thing you do when times are tough. They see it as the essential strategic fuel that's necessary to finance pillar 2, that superiority investment. The savings from being more efficient directly fund the R&D for better products.
Ah, okay, I see the link. Savings fund innovation. What's pillar 4?
Pillar 4 is constructive disruption. Now, this isn't just a corporate buzzword. They mean it as a mandate to innovate and adapt how they operate, even if it means challenging their own established, profitable ways of doing things.
Can you give an example?
Yeah, a classic historical example of P&G practicing disruption against itself was the launch of the Swiffer back in the late 90s.
Oh, yeah, I remember that. Huge launch.
Huge. And think about it, Swiffer directly cannibalized their own existing mop and bucket cleaning brands. But they did it anyway, because it defined a whole new, much more convenient cleaning category, ensuring they remained the market leader, not some startup. That willingness to sometimes destroy your old successful models to build better new ones, that's key to long-term survival.
Wow, okay. Disrupting yourself. Gutsy. And the last pillar.
Pillar 5 is organization. Basically having an agile and accountable structure to actually execute all this globally, making sure the machine runs smoothly.
So those 5 pillars: portfolio, superiority, productivity, constructive disruption, organization. That's the framework.
That's the framework. And the durability of this whole model, it's rooted not just in how well they execute, but fundamentally in the nature of their products. They're non-discretionary, mostly.
Right, back to the detergent point.
Exactly. During a recession, when household budgets get really tight, P&G products are often one of the very last things people cut back on. You might buy cheaper pasta, but you probably still buy toothpaste and diapers. That intrinsic stability of the product basket acts as this extraordinary buffer against economic downturns.
Okay, so they have this incredibly defensive portfolio, this strong strategic framework. But despite all that strength, P&G operates in an industry, consumer packaged goods, CPG, where the ground is fundamentally shifting underneath them. That competitive moat they relied on for a century, it seems like it's facing real structural erosion now.
That's right. The overall CPG market globally is mature. Growth forecasts are pretty modest, maybe 3% to 5% compound annual growth rate, CAGR. It's just not a category where you're going to see explosive volume-driven expansion anymore, especially in developed countries.
And that saturation point in places like the US really makes this clear, right? We looked at the recent data. Sales growth in the last few years was driven almost entirely by P&G raising prices. The actual volume, the number of units sold, has been basically flat.
Flat volume. That's the key signal. It really suggests they're kind of maxing out the number of units they can realistically sell in these core markets. Consumers are essentially paying more for the same amount of stuff. That can't go on forever.
And layered on top of that saturation, you have this huge demographic shift happening. This is where it gets really interesting, I think.
Yeah, absolutely. Millennials, and especially Gen Z, they grow up online, they're digitally native. And the data shows they are significantly less brand loyal than, say, baby boomers or older generations would.
Why is that? What do they care about?
Well, they prioritize different things. Value for money is big, but also sustainability, authentic corporate values, what a brand stands for. And this fundamentally breaks P&G's historical marketing playbook, doesn't it?
Also,
For decades, P&G perfected mass marketing. The 30-second TV ad during prime time, reaching millions at once, that built brands like Tide. But younger consumers aren't watching network TV in the same way. P&G now has to engage them through much more complex, fragmented, personalized digital channels. And they have to adjust their messaging constantly around things like environmental impact, ethical sourcing. It's a whole new ballgame.
okay, so the consumer is changing, the market is saturated. Let's talk about those traditional competitive advantages, the moat. Historically, P&G seemed untouchable because of these huge barriers to entry. How are those holding up?
Yeah, traditionally there were three formidable barriers that really protected P&G. Let's tick through them and see how they're dissolving.
Okay, barrier one.
First, brand loyalty. This is the absolute bedrock, right? Built over decades, spending billions upon billions on advertising, creating these deeply entrenched consumer habits. You bought Tide because your mother bought Tide.
Got it. Barrier two.
Second, economies of scale. P&G's sheer size, their ability to manufacture, source raw materials, ship products globally at massive scale, gave them unbeatable cost advantages. No small player could compete on price.
Makes sense. And the third barrier, this one was always very visible.
Yeah. Number three was distribution and shelf space. Those long-standing powerful relationships with major retailers like Walmart, Target, Kroger. That guaranteed P&G the best physical placement in the store, the eye-level slot on the shelf, the big end-of-aisle display. And for decades, that physical placement was probably the single most powerful factor driving what you actually put in your shopping cart.
If it's right there in front of you, you grab it.
Exactly. But now, the rise of e-commerce has launched what you could call a digital assault on those barriers.
How specifically?
Well, think about the infinite shelf online. E-commerce basically eliminates that third barrier, the distribution and physical shelf space advantage for smaller competitors. Suddenly, a niche, maybe eco-friendly diaper brand started by a couple of entrepreneurs in California has the same theoretical shelf space on Amazon as Pampers.
Ah, okay. Levels the playing field dramatically.
Completely. Market dominance is shifting. It's no longer purely about physical power and retailer relationships. It's increasingly about digital acumen. Things like search engine optimization, getting good consumer reviews, running targeted digital marketing campaigns. Those are the new gatekeepers online. It has totally leveled the traditional playing field.
So if scale and physical placement are becoming less relevant, or at least less decisive, what's fueling that competitive gap? You mentioned twin threats earlier.
Yeah, we're seeing two major competitive threats growing stronger literally every quarter. They're intertwined with this digital shift. Threat number one, The rise, or maybe the ascent, of private label brands, store brands.
Like Costco's Kirkland Signature or Target's brands or Kroger's Simple Truth.
Exactly. And these are fundamentally different beasts from the cheap, generic, black and white packaged store brands of the 1980s. Retailers have invested heavily in the quality, the packaging, the marketing of their own brands. They've achieved what many consumers now perceive as near parity, or even superiority in some cases, compared to the national brands like P&G's.
And consumers are buying them more, especially
Hey,
lately.
definitely. Spurred by recent inflation, tighter household budgets, people are actively prioritizing value. And the result is this undeniable surge in private label. Private label now accounts for a really substantial 19% of the total U.S. CPG market. That's nearly 1/5 of everything sold. It's a huge and likely permanent structural shift in the market.
Wow, 19%. That must create a massive headache for P&G.
It creates a devastating dilemma, actually. Think about it. If P&G cuts prices significantly on, say, Tide to aggressively fight back against Kirkland detergent at Costco, what happens?
Price war.
Exactly. They risk triggering a catastrophic price war that just destroys profit margins for the entire category, including their own. It's value destroying for everyone. But if they just maintain their premium price and try to ignore the private labels,
They risk losing volume.
they risk a slow, steady erosion of volume as more and more value-conscious consumers try the store brand, find out it's pretty good, and then permanently switch. They get conditioned to the lower price. P&G basically has to innovate its way out of this trap, constantly proving its products are worth the premium.
Okay, that's threat one. High quality, private labels, stealing share. What's threat two?
Threat number 2 is really the channel shift itself, the move to e-commerce and the rise of digital native brands. E-commerce now accounts for, 22% of core U.S. retail sales as of Q2 2025. It's massive.
And P&G is adapting, right? You said their e-commerce sales are growing.
They are adapting, yes. Their own e-commerce sales grew a healthy 12% in fiscal 2025 and now make up 19% of their total revenue. So they're definitely playing the game. But the structural challenge is profound. This shift means P&G has to transform its very DNA. They have to evolve from being masters of mass media experts at buying Super Bowl ad slots into leaders in data analytics and personalized digital marketing.
From broadcast to targeted algorithms?
Precisely. That transformation is incredibly costly, but it's absolutely necessary for survival. P&G now has to use sophisticated programmatic buying, basically using algorithms to target you, the individual consumer, with a personalized ad for, say, Crest Pro Health toothpaste maybe moments before you shop online, based on your past search history or purchase data. The old way was broad marketing reach. The new way is hyper-personalized, data-intensive digital influence at the point of purchase. It's a completely different skill set.
Okay, so P&G is facing these significant disruptions. Saturation, changing consumers, private label, the digital shift. Their ability to actually manage these disruptions, and especially to fund that massive digital evolution you just described, seems to rely entirely on the strength of their financial fortress. A structure they built over years of pretty focused transformation.
That's exactly right. The foundation for their current strength was really laid almost a decade ago. You can think of it in phases. Phase 1, roughly 2015 to 2018, was what they call the era of strategic pruning.
Pruning, meaning cutting brands.
Cutting brands, yeah. P&G leadership recognized they had become too sprawling, managing way too many brands, which scattered their focus and resources. So they divested dozens and dozens of non-core businesses, including some massive ones, remember. They sold off Duracell batteries, a bunch of beauty brands.
Right, I remember Duracell. That focus must have been painful in the short term, though. Sales probably went down.
They did. Net sales were flat or even declining during that divestiture period. But it was necessary pain, because it paved the way for Phase 2, which started around 2019. And Phase 2 saw P&G return to really consistent growth, driven specifically by those 10 core high-performance categories they decided to keep.
And the numbers showed it worked.
Absolutely. Net sales climbed steadily, reaching $84.3 billion in fiscal year 2025. And maybe more importantly, organic sales growth, which strips out acquisitions and currency effects, averaged over 5% annually between fiscal 2019 and 2024. That shows the focus strategy really paid off for a good long stretch.
Okay, so focus led to consistent growth. And that focus and their massive scale, that translates into profitability metrics that are really top tier, right? Best in class within the CPG world.
Truly best in class, yeah. Let's look at the numbers from FY 2025. P&G reported a gross margin of 51.2%. That's impressive already. But then look at the operating margin, a hugely robust 24.3%.
24.3% operating margin on $84 billion in sales. That's enormous profit.
It is. And while some peers, maybe Colgate-Palmolive, might report slightly higher gross margins in specific categories like toothpaste, P&G's sheer scale allows it to leverage massive operating efficiencies, lower overhead, better logistics, etc. That's what results in that superior 24.3% operating margin overall. It indicates just ruthless control over costs below the gross profit line.
And that control extends to how they use their money, the capital.
Yes, absolutely.
Yes.
Look at their return on invested capital, ROIC. It was a very strong 15.6% in FY25. This reflects a company that doesn't just throw money around. It's exceptionally good at allocating capital only to projects that are highly profitable and defensible within that core strategy. No wasted investment.
And a big reason they can maintain those high profits and returns is their market position, right? They dominate their categories.
They dominate. P&G holds either the #1 or #2 market share position in virtually all of its core markets. This often creates these classic rational duopolies.
Duopolies, like two main players.
Exactly. Look at the data. In the U.S. diaper market, it's basically Pampers versus Kimberly-Clark's Huggies. Together, they split something like 75% to 76% of the entire market.
Wow.
In U.S. toothpaste, it's Crest versus Colgate. Another classic duopoly. Globally, in the huge laundry detergent market, P&G commands nearly 30% share through Tide and Ariel combined. When you have that level of market control, just one or two dominant players, it historically ensures more rational, disciplined pricing behavior in the industry. Less crazy price wars, which protects those industry-leading margins for P&G.
Okay, so category dominance underpins the profitability. Now let's connect back to where we started, that $17.8 billion in operating cash flow they generated in FY 2025. How do we know that cash flow is, real and sustainable, not just accounting profits?
That's a great question. The key metric P&G themselves track very closely is cash conversion. Specifically, they target something called adjusted free cash flow productivity.
Okay, what's that?
It's basically operating cash flow divided by net earnings. It tells you how much of the reported profit is actually turning into cold, hard cash. P&G aims for 90% or higher on this metric over time. They actually hit 87% in 2025, which is solid, and they were at an amazing 105% in 2024.
So hitting close to 90% means the profits are real.
It proves the quality of their earnings, yeah. The profits you see on the income statement are robustly backed by actual cash flowing into the company's bank account. It's not just paper profit.
And this reliable cash flow, this is what feeds that virtuous cycle you mentioned earlier, the core strategic loop that defines P&G.
Exactly. That cash flow is the essential fuel tank for the whole strategy. Remember, Pillar 3 was productivity.
Right, the relentless focus on cost savings.
Well, P&G generated an incredible $2.3 billion in pre-tax productivity savings in fiscal year 2024 alone. And this isn't just, turning off the lights. This is deep structural stuff. Optimizing global supply chains, reducing raw material waste in factories, streamlining logistics networks using data.
$2.3 billion in savings in 1 year.
In 1 year. And that huge saving, that $2.3 billion, is explicitly viewed as the mandatory funding mechanism that supports Pillar 2, superiority.
Yeah.
Specifically, those savings help fund the more than $2 billion P&G invests every single year into research and development and innovation.
I see the loop clearly now. It's simple but powerful, isn't it?
It is. Productivity savings fund superiority, better products. That superiority justifies premium pricing and protects their brand power, which then generates the high margins and cash flow needed.
Start the cycle all over again by investing in more productivity.
You got it. In a saturated market where just selling more units is really challenging, productivity isn't just about efficiency for its own sake. It is the only engine that reliably funds their future growth and defends their margins against those private label threats. It's absolutely critical.
Yeah.
Okay, so that virtuous cycle sounds pretty impenetrable, right? Productivity funding, superiority funding pricing. But the most recent results from fiscal year 2025 show that even this powerful strategic machine is running into some significant headwinds. Specifically, it looks like they might be hitting the limit of their pricing power.
Ah, right. We saw that earlier with the flat volume. There was a clear deceleration signal in the FY 2025 numbers, wasn't there? organic sales growth, which had been humming along above 5% for several years, well, it dropped pretty sharply down to just 2% for the full year.
Yeah, a big slowdown from 4% the year before, and even higher before that. And when you actually unpack how they got that 2% growth, the picture gets a bit concerning. As we noted, reported net sales were basically flat year over year at $84.3 billion.
How can organic growth be 2% if net sales were flat?
Good question. It breaks down like this. They managed to eke out a plus 1% benefit from raising prices. But that was completely wiped out by a negative 1% hit from unfavorable foreign exchange rates, currency fluctuations. So those two canceled each other out.
Okay.
But the really critical piece of data, the one management is surely focused on, is that overall volume was flat. 0% volume growth.
Flat volume, selling the exact same amount of detergent, diapers, toothpaste as the year before. That really is the clearest signal, isn't it? It suggests they've pretty much reached the limit of their ability to just keep hiking prices without consumers pushing back.
Exactly. Consumers are actively resisting further price hikes. They're signaling they're willing to either cut back on consumption slightly or, more critically for P&G, trade down aggressively to those high-quality private label alternatives we talked about. P&G now has to find growth through genuine innovation and efficiency, not just by riding inflation anymore.
So did management see this coming? What are they doing about it?
Well, the signals were there through the year. And yes, management recognized this inflection point pretty quickly. They proactively pivoted the strategy, shifting the emphasis back towards internal efficiency and productivity. They announced a major restructuring plan back in June 2025.
A restructuring. What does that involve? Layoffs.
It's substantial, yes. It focuses squarely on the internal cost structure. It involves a significant reduction of up to 7,000 non-manufacturing roles. Think corporate overhead, marketing, administrative staff over the next 2 years.
7,000 roles. That's a big number.
It is. That represents roughly 15% of that particular employee cohort. It really demonstrates how seriously P&G is doubling down on that productivity pillar again, trying to claw back margins and generate savings to reinvest.
Are they doing anything else besides headcount reductions?
Yes, they're also becoming more ruthless about where they operate. They're pulling out of or significantly restructuring in unstable or unprofitable markets that were draining management attention and resources. A tangible example was the liquidation of their on-the-ground operations in Argentina back in Q1 of fiscal 2025. It's part of that relentless focus on portfolio optimization only play where you can win profitably.
Okay, so they're cutting costs, streamlining, but this need for ruthless efficiency and also for that constructive disruption pillar you mentioned, it makes me wonder about the planned CEO succession.
Ah, yes. Gilles Jujurikar is set to take over from the current CEO, John Moyler, in January 2026.
Right, and Jujurikar is a long timer, isn't he? Like a 36-year P&G veteran.
He is a classic P&G lifer, as they
Oh.
sometimes say.
So, given the need to fight off digital insurgents and maybe shake things up, doesn't selecting another insider, a company lifer, maybe signal a preference for consistency and just incremental efficiency rather than the potentially more radical change needed to truly transform their digital relationship with consumers? Is he the right guy to constructively disrupt?
That is the absolute central strategic tension right now, and it's an excellent point you raise. The argument for continuity for picking Jujurikar is all about execution precision.
Yeah.
Both Mueller and Jujurikar were architects of the current integrated growth model that has been, let's face it, highly successful for years.
Okay.
Selecting a veteran basically guarantees that this difficult restructuring plan, the 7,000 job cuts, the market exits, will be executed with surgical consistency. They know the P&G system inside out.
But the risk.
The risk is exactly what you highlighted. Is a leadership team composed almost entirely of insiders nimble enough, maybe even willing enough, to truly disrupt its own successful, highly profitable structure to meet the digital challenge head-on? Management is clearly betting that relentless efficiency and internally funded innovation is the best defense, rather than, say, making radical external acquisitions or bringing in disruptive outsiders to change the culture. It's a calculated bet on their existing system.
A bet on the P&G way, essentially. Okay, so if price hikes are largely off the table now and they're cutting costs internally to fund things, where does actual volume growth come from moving forward? Selling more stuff.
Right, that's the billion-dollar question. There are really three key growth opportunities they're pursuing. First is continued premiumization and innovation. That $2 billion plus annual R&D budget is laser-focused on introducing genuine product breakthroughs that can actually justify a premium price tag, even in this environment.
Like what kind of breakthroughs?
We're talking about true product form innovation. Things like the new, highly concentrated Tide Evo pods they just launched, or the redesigned Swiffer Power Mop. These offer a demonstrable functional benefit, better cleaning, more convenience that the private labels hopefully can't replicate immediately. That's the goal. Innovate faster than the copiers.
Okay, innovation drives premiumization. What's the second growth source?
The second, and potentially the largest long-term volume opportunity, lies outside the developed world. It's emerging markets.
Back to Asia, Latin America, Africa.
Exactly. P&G management estimates there's a massive long-term potential, maybe $10 to $15 billion in extra annual sales, just by increasing the per capita consumption of their products in developing nations up to levels closer to what's common in the West.
So convincing more people in India or Brazil to use disposable diapers or branded shampoo more often?
Essentially, yes. And that requires everything from building out distribution networks in rural areas to carefully localizing products. For example, adapting Ariel detergent formulations for the different water types and washing habits you find in India versus China versus Nigeria. It's complex, but the volume prize is huge.
Okay, innovation in emerging markets. What's the third avenue for growth?
The third avenue is getting much, much better at digital acumen. It's deepening their expertise there. As we discussed, P&G is rapidly adapting. They're now using programmatic buying and algorithm-based media for over 80% of their U.S. media spending.
80%? That's a huge shift from TV ads.
Massive shift.
Yeah.
It allows them to move media dollars away from potentially wasteful mass broadcasts and channel them directly toward hyper-targeted consumers right at the digital point of sale, based on data. That digital efficiency not only protects their margins by reducing wasted ad spend, but it also maximizes the effectiveness of their marketing in actually driving sales conversions online. They have to win the digital shelf.
All right, let's shift gears a bit and talk about the financial philosophy that really underpins P&G's reputation as such a compelling, sort of defensive blue chip investment. Their status rests heavily on how they allocate capital, doesn't it?
Oh, entirely. Their capital allocation strategy is a model of clarity and consistency. It's very simple, really. Priority number one, reinvest sufficiently back into the business to maintain that superiority. That means R&D, which we talked about, and also capital expenditures, CapEx, typically at a disciplined 4% to 5% of sales each year for factories and equipment.
Okay, reinvest first. What's priority two?
Priority two is return virtually all remaining cash flow to shareholders. Give it back.
All of it.
Pretty much all of it, through dividends and share buybacks. This is what earns them that truly elite status as a dividend king.
Dividend king, I've heard that term. What does it actually mean?
It means they have an incredibly long track record of not just paying, but increasing their dividend every single year. P&G's record is astounding, maybe unparalleled. They've paid a dividend consecutively for 135 years. And crucially, they have increased that dividend payout for 69 consecutive years. Think about that. Through recessions, wars, market crashes, pandemics, changing consumer tastes for 69 years straight, the dividend went up. That level of consistency is extraordinary.
69 years of raises. That is remarkable consistency.
It really is. And the sheer scale of the cash they return to shareholders confirms that P&G generates massive amounts of surplus cash, more than they can profitably reinvest back into their own business at those high return thresholds they demand.
How much did they return recently?
In fiscal year 2025 alone, they returned over $16 billion to shareholders. That was about $10 billion paid out in dividends and another $6.5 billion used to buy back their own stock.
$16 billion in 1 year just given back to investors.
Yeah. It implies the company is such an efficient cash generator that it literally produces more cash that it can find productive uses for internally, according to its own strict criteria. That makes it arguably the ultimate cash distribution vehicle for investors who are seeking stable, reliable income.
Okay, so huge, reliable cash returns. But isn't there a risk hidden in their reliance on huge scale and those traditional retailer relationships, particularly customer concentration?
Yes, that's a key risk to monitor. P&G is huge, but some of its customers are even bigger. Sales to just one customer, their largest, Walmart Inc., accounted for approximately 16% of P&G's total global sales in FY 2025.
16% to Walmart alone. That gives Walmart immense bargaining power over P&G, right?
That's it.
On pricing, on shelf placement, on trade terms.
Immense leverage, absolutely. But what's really fascinating here is how this risk, this retailer power, has evolved in the digital age. It's moved beyond just simple bargaining power over price.
How so?
Retailers like Walmart and especially Amazon, Target too, they're no longer just passive distributors of P&G's products. They now run their own powerful retail media networks, or RMNs.
Retail media networks. Like advertising businesses within the retailer.
Exactly. They're essentially becoming media companies. So if P&G wants its Tide detergent to show up prominently when you search on Walmart.com, or if P&G wants to use Walmart's valuable proprietary shopper data to target digital ads to specific customer segments,
They have to pay Walmart for that.
they have to pay Walmart's RMN, Walmart Connect, for that privilege. They have to buy advertising on Walmart's platform, just like they used to buy TV ads.
Ah, so P&G's marketing budget is increasingly flowing to its retailers, not just through traditional media.
Precisely. P&G used to spend billions on TV networks, magazines, billboards. Now, a rapidly growing portion of those billions is being shifted directly to the RMNs run by Amazon, Walmart, Kroger, Target, and others. This isn't just a temporary shift, it's becoming a structural cost of doing business.
And what's the impact?
The impact is that it transfers profit margin directly from the manufacturer, P&G, to the retailer. As these RMNs grow stronger and more sophisticated, they effectively levy a kind of digital toll that P&G must pay to secure good digital shelf space and, crucially, to access the shopper data needed for effective targeted marketing. It creates a permanent and likely growing margin headwind for P&G and other CPG companies.
Wow. So the retailers are capturing more of the value chain. That's a subtle but powerful shift. Okay, finally, let's bring this all together and look at valuation. How does the market actually price this unique combination of stability, cash return, but also these structural threats we've discussed?
Right. If you look at P&G's valuation metrics, say, its trailing 12-month price-to-earnings ratio, the PE ratio, it consistently trades at a significant premium compared to its direct competitors like Unilever or Kimberly-Clark, currently around 23.3 times earnings.
Okay, a PE of 23.3. Why the premium? It's not a high-growth tech stock.
Exactly. The valuation is certainly not justified by expectations of high growth. As we've seen, their realistic long-term organic growth outlook is probably in the modest 2% to 4% range per year, low single digits.
So why pay 23 times earnings for 3% growth?
The premium is awarded almost entirely for its defensive status and its perceived superior quality. Investors are paying extra for predictability,
Predictable cash flow, high profitability.
a fortress balance sheet, and that unmatched track record of consistently returning cash to shareholders via dividends and buybacks. In volatile markets, P&G often functions as a stable, safe haven asset. Investors flock to it when they're nervous.
So it's valued for safety, not speed.
Perfectly put. Safety, not speed. And this leads us directly to the biggest valuation risk for P&G investors. It's not necessarily that earnings will suddenly collapse. That seems unlikely given the nature of their products.
What is the risk then?
The biggest risk is a potential compression of that premium multiple. If the market starts to perceive that P&G safety status is eroding, maybe because private label really starts to aggressively steal significant market share in a core category like diapers, or perhaps if their pipeline of innovation fails to consistently justify premium pricing, then investors could simply decide that the predictability isn't worth paying 23 times earnings for anymore.
And they'd sell, driving the PE multiple down.
Exactly. They might rotate that capital into stocks they perceive as having better growth prospects or less structural pressure. So the stock price could fall due to multiple compression, even if P&G's actual earnings remain relatively stable. That's the key valuation risk here, losing that safety premium. Hashtag tag out Doutro.
Okay, so to try and bring this deep dive full circle, P&G is this incredible, nearly 2-century-old, hyper-efficient machine built on unparalleled brand power, global scale, deep retailer relationships. Just a fortress.
A fortress, yes. But that fortress structure is now under sustained structural pressure from, really, two very clear forces we've unpacked. First, the dramatic rise in the quality and consumer acceptance of private label products, eating away at the value proposition.
And second, that fundamental shift to the digital shelf, which neutralizes P&G's traditional advantages in physical distribution and mass marketing, while empowering smaller, nimbler competitors.
Right. And its future success, especially now that just raising prices seems difficult with volume being flat, hinges almost entirely on its ability to keep funding genuine product innovation and superiority, think Tide Evo, the new Swiffer, through those ruthless internal efficiency gains and productivity savings.
Well, also somehow capturing this big long-term volume opportunities in emerging markets. It's a tough balancing act.
It is. So you now know the core strategic equation, that virtuous cycle. Productivity funds superiority, which should allow for premium pricing. But here's the final thought for you, the listener, to mull over.
Okay, let's hear it.
If the rise of these powerful retailer media networks, these RMNs, continues to increase the structural toll that P&G must pay its biggest customers, like Walmart and Amazon, just for digital access and essential shopper data. Will those billions in internal productivity savings they generate still be enough to both maintain their industry-leading margins and successfully fuel the massive innovation engine needed for true sustainable volume growth?
Or will more and more of those hard-won savings just get transferred to the retailers as the cost of doing business in the digital age?
Exactly. Is the productivity engine strong enough to overcome the rising digital toll? That's the ultimate question, I think, for investors and for P&G's leadership heading into 2026 and beyond. Something for you to definitely mull over next time you're in the supermarket aisle picking up a tube of Crest or a bottle of Tide.